Hey, welcome back. Good morning to all of the options traders. And I wanted to talk a little bit about one of my favorite topics in options trading, and that is about parity. And sometimes when traders hear some of these technical definitions and terms, they say, why do you really need that stuff? They're just technicalities. Who cares? Well, that's definitely not true. There's a reason that they're taught. And what I wanted to show is that when you understand what parity is, it's going to go a long way in helping you to decipher some of the more complicated strategies. It can also help to keep you from making bad decisions. So let's go find out more about parity and why it's so important to understand. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and goes a long way into promoting the channel. Let's start off with the definition of parity. Parity is just a fancy word for equivalence. And in the options market, what we're saying is that it's equivalent to stock. Or in the case of a put option, it could be equivalent to short shares of stock. Those options are behaving just like shares of stock once they're trading at parity. So remember that this condition will arise when the option only has intrinsic value, in other words, no extrinsic value. So there are two basic conditions where an option will trade at parity. First, it either has to be in the money at expiration, even if by a little bit, it will trade at parity. Or it has to be very deep in the money prior to expiration. And in those cases, it can also trade at parity. So for example, let's say that the stock is 100 and you find that the $80 call is trading for 20. Well, that's trading at parity. And one way we can figure that out is to take the $80 strike plus the $20 premium, and we find out that comes up to 100, exactly the current stock price. So if you paid $20 for the $80 call and exercised it and paid 80, you have paid 100, which is exactly the same price you would have paid for buying the shares right now. So at this moment, that $80 call is trading at parity. Now, technically speaking, that's really what we need to see, where it's all intrinsic value and no extrinsic value. In the real world, if it's really close, we'll still call it parity. Remember that all options have to trade for at least intrinsic value at all times. So this option would have to trade for at least 20, but maybe it's trading for $20.30. We'd still call that parity. So when the call is trading at parity, it is behaving like long shares of stock. Now for the puts, it'll be just the opposite. We would need the put to be very deep in the money. So with the stock at 100, if you were looking at, let's say, the 120 put trading for 20, well, it has $20 of intrinsic value, and that just happens to be the exact price of the put. So in this example, the put is trading at parity, and that means that it's equivalent to short shares of stock. Okay, so that's the definition. So why is this important? Well, remember it's the extrinsic value of the option that makes it the option. When we talk about an option, the intrinsic value has nothing to do with what we call the optionality portion. So for example, let's say the stock is 100 and you find the $95 call trading for 7. Well, we know that you have the right to pay 95 for stock currently valued at 100. Well, that's a $5 benefit. So there is $5 of intrinsic value. However, the option's not trading for 5, it's trading for 7. So there's an extra $2 in here coming from somewhere. Where's that coming from? It's coming from the extrinsic value. This $2 is the price you pay for the right to walk away. That's the insurance policy. So again, a lot of traders will look at this and say, oh, I'm paying $7 for the option. No, you're not. You're paying $5 of intrinsic value. That's just cash. But you're paying an extra $2 for the right to walk away. So it's this extrinsic value that we really have to keep our eye on. And that's really what drives most of your option strategies. Okay, so how can we use this concept of parity to make better decisions? Well, let's start with a very common trap that traders fall into with the covered call. Let's say the stock is trading for 100 and you sell the at the money $100 call and you collect $3. And then later the stock rises to 110 and you're very close to expiration, so you buy this $100 call back for exactly $10 of intrinsic value. And the question is, did you lose money? Now, most traders will quickly say, well, obviously, I collected $3 from the call and then I spent 10 down here to buy it back, so it's a loss of 7. Yes, I lost money. Well, it looks like that, but remember you also own the stock, and the stock went up 10 points. So let's take a closer look at the details of the trade. When you bought the shares, you spent $100 for them. You sold the 100 call, collected 3. That's a net cost or a net debit of $97. Now, when the stock rises to 110, you turned around and you bought the $100 call to close and you spent 10 bucks. But take a look at your net cost. You spent 97 and later spent 10. That is a net cost of 107 and the stock is at 110. So if you have a net cost of 107 and the stock is at 110, why is that a loss? Notice that it's a gain of 3, which is exactly the price you received for that covered call. And that's where that $3 gain is coming from. Now again, it might look kind of odd, or that we have to step through all of these sequences here to figure that out. But watch how easy it is once we understand parity. When you sold this call, it was an at-the-money option, so there's no intrinsic value. You sold it for $3 over parity. When you bought it back, what was it trading for? See, it looks like you paid 10 to buy it back, and I guess technically speaking you did, but you didn't pay 10 for the option. You bought it for $0 over parity. So what happens if you sell something for $3 over and buy it back for 0? That's a gain of 3. But you see how easy it was to get to that conclusion without going through all of the steps. And so that's why it's super important to be able to figure out parity, because you can quickly figure out, in this case, gains and losses. All right, let's take a look at a second example. Let's say the stock is maybe at 102. So you spend 102, you sell the $100 call for 7. Now it's not an at-the-money option. It's got 2 points of intrinsic value. And that may seem like it's going to make it more confusing until you understand parity. So let's say the stock is 115 at expiration or getting close to expiration, and you buy the $100 call to close for 16 bucks. So it's got $15 of intrinsic value, but you pay 16. So the question is, did you lose money? And again, traders would say, well, yes, I lost a lot because I sold it for 7 and bought it back for 16. Well, let's now put it under the lens of parity. When you sold the option, you sold it for $5 over parity, right? There's $2 of intrinsic value, and therefore $5 was extrinsic value. You sold it for $5 over. How much did you buy it back for down here? It has $15 of intrinsic value. You paid 16, so you bought it for $1 over parity. So if you sold it for 5 and bought it back for 1, that's a net gain of 4. That's not a loss, it's a net gain of 4, and I can quickly see that just by looking at parity. Let's look at a third example. You see this a lot with vertical spreads. Let's put our stock back at 100, and let's say that you buy the 95 call, you spend 6, you sell the 100 call, collect 4. And that would be a net debit of 2. That's just the net between those two prices. So the question now, does this vertical spread have negative theta? And most traders would say, well, obviously it does because it's a debit trade. You spent money for it, and therefore it's got to decay over time. Well, remember that the only portion of an option's price that's decayable is the extrinsic value. And so the debit might not tell the whole story. So let's go take a look at it in terms of parity. When you sold this call for 4, that was all extrinsic value, right? The stock is 100, you're selling the at-the-money option. You sold it for $4 over parity. Now let's take a look at the long option. When you bought it, you paid $1 over parity. It's a 95 call with the stock at 100, so there's $5 of intrinsic value, which isn't a concern, it's just intrinsic value. But you paid 6. So there's an extra dollar, that's the extrinsic value. So when you paid 6 for this option, you bought it for $1 over parity. So you can look at this spread as though you sold it for 4 and bought it for 1. It's actually a credit in terms of the extrinsic value. And so it's going to have positive theta since you've sold more extrinsic value than the amount that you paid. And it's super easy to see once you learn to see option strategies in terms of parity. So, the main thing to take from this is that understanding parity allows you to quickly figure out how a strategy will work or how it won't work. Always remember that the extrinsic value, the time value, is the price you pay for the right to walk away. And that's what makes an option an option. Track the extrinsic values, the amount over parity, and you'll quickly decode complex strategies. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsa2z.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.